Hello, and welcome to an accounting tutorial of Wacc. So first, we need to understand that Wacc, or weighted average cost of capital, is a finance subject. Therefore, what we refer here to as capital is not equity in accounting, but it is the assets. So basically, what we're asking here is how much is the weighted average cost of using these assets. Assets come from two things: liabilities and equities. So first, we need to understand that in order for us to accumulate money or assets or capital is we need to incur liabilities or issue equity through shares. Now that we know that assets come from two things, liabilities and equities, we can now understand why it is called the weighted average cost of capital. Weighted because there are two things that you consider, liabilities and equities. Therefore, we're not going to use the simple average, which looks like this: liabilities plus equities divided by 2. Because in simple average, we're assuming that all things are equal. So we're basically saying that liabilities is 50% and equity is 50%, which is wrong. Because a company has the policy of having different kinds of liabilities and equity proportions. Now, when we're talking about weighted average cost of capital, it looks like this. It could be 30-70, 50-50, or 60-40, whatever the choice of the company. Now that we've understood why it is weighted average and why it is cost of capital, so we're basically asking how much is the cost or the weighted average cost of using these assets or capital. Now, like what I've said before, assets or capital comes from two things, liabilities and equities. Now, let's talk about liabilities. Now, when we talk about liabilities, it's basically we're loaning money from creditors. Now, if we loan money from creditors, we're going to incur costs. Now, what is that cost? Well, that cost is interest. So, in order for you to have a loan, you need to pay something in return, which is the interest, because it is onerous and not gratuitous. And so, in order for you to loan money, you need to pay interest, which is the cost of acquiring the capital or money or asset in order for you to have them. Now, the interest expense is a P&L item. Therefore, it reduces net income. Now, if it reduces net income, it has an effect, most commonly known as a tax savings effect. Therefore, when we compute the weighted average cost of capital and we talk about liabilities, liabilities must be multiplied by 1 minus the tax rate. Because remember that interest expense reduces net income, and if it reduces net income, it has a tax effect, which is a tax savings. Therefore, we need to multiply it by 1 minus tax rate. So, assuming, let's say 30% is the tax rate, you need to multiply the interest rate by 70%. Now, for the last portion, equity. So now when we talk about equity, we're basically talking about issuance of shares. Now, when we talk about issuance of shares, it can come from two things, common shares or preference shares. So in order for you to accumulate funds from investors, you need to issue shares, either common or preference. Once you've issued the shares, you acquire money or capital. Now, what is the cost of acquiring this capital? It's of course dividends. When we talk about dividends, you pay common and preference shares. Now remember, in the tax code, you do not deduct dividends in order for you to arrive at the net income. Rather, after we get the after-tax net income, we deduct the dividends in order to arrive at the net income attributable to common shareholders. So when you talk about dividends, we do not need to multiply it by 1 minus tax rate because it does not have any tax savings effects, unlike interest. Now, let's talk about the cost of equity. So, unlike liability, which is basic because you just need to find out the interest rate, which is always given. Now, it's different from equity because in equity, you need to solve it first. So, the computation of equity is just a basic equation. Dividends divided by the price plus the growth rate if it's common shares. Now, when we talk about preference shares, it's just dividends divided by the price. Now, why is there a plus growth rate in the common shares? Simple. It's because when you talk about preference shares, there is a fixed dividends. Remember that when you talk about preference shares, there is a rate already because they have priority over the earnings. Unlike common shares, which only get the residual earnings after deducting the preference dividends. Because the dividends of the common shareholders are not constant. Therefore, we need to account for it using the G or a plus G. Now that we know the interest rate and the cost of equity, we just multiply it by the respective weighted averages, which is usually given in the problems. So now to summarize, I'm going to give an illustrative example. Now, for example, a company has 1 million assets and 60% of it comes from liabilities and 40% comes from equity. Therefore, we know that the weighted averages is 60 and 40. Now, the company loans money at an interest rate of 10% with a tax rate of 30%. Therefore, we just need to do is 10% times 70% times 60%, which is the weighted average. Plus, now the company issues shares with a price of 20 and it's going to declare dividends of 5 pesos per share and with a growth rate of 5%. So to compute, 5, which is the dividends per share, divided by 20 or the price plus the growth rate of 5% multiplied by 40%, which is the average. Now, the total is, tada! Thank you for watching. That was a crash course in Wacc.